Money Show.
Personal Finance with Warren Ingram.
Personal Finance brought to you by Discovery Bank, the future of banking now. Warren Ingram from Galileo Capital is a personal financial advisor. He's an executive director at Galileo Capital. He joins us on a Thursday night to talk about personal finance. And I remember one of the very first discussions I ever had with somebody as a financial journalist talking about, they worked in a bank. I can't remember who they were, and I don't remember the exact circumstances of the discussion. But I remember this person very earnestly telling me that when you get to the age of 55, you need to start de-risking. You need to start taking money out of the share market and start investing it in bonds because you need certainty. So when you retire at 60, then you've got absolute certainty as to how much money you've got, and then you can budget after that and be very, very cautious about your money. And this is somebody who was a very senior person within banking, as I remember it. And I remember at the time thinking, that sounds a bit weird. And it's something that I think makes your face go a bright shade of puce, because it's very damaging, I think, to long-term wealth.
Absolutely, Bruce. I think advice like that is really designed for maybe the 1950s. Not the 2020s, because in the 1950s, people didn't live that long, and so if you retired at 60, realistically, I think life expectancy at that time was probably around 65 to 68 years old. So if people were de-risking their retirement, going for certainty, they only really had to worry about a 5 to 8 year period of their own lifetime if they wanted to make sure they had enough income and that income was adjusting to inflation. So fine, no problem. But if you retire at 60 today, there's a very good chance that you live to kind of age 85, 88 very comfortably, and the oldest people in the world are comfortably in their 100 and teens. And that would be awful advice, because then inflation just absolutely destroys the value of your money. So all you do with that certainty is you make absolutely sure you'll never have enough money to keep up with your cost of living as it changes.
So then we come to this thing, and it sounds incredibly boring, but it's probably one of the most important things that you have to consider when it comes to your investments, particularly when you're not working anymore and you don't have income. So you are now living off your savings, off your investments. And it's this thing called asset allocation.
Yeah, I mean, I hate the fact that you call it boring, Bruce. I mean, for me, it's probably the most exciting part of every day of my working life.
That's because you're a financial advisor and you need a life.
So, asset allocation, the mix.
I think it needs a better name.
Cash,
it needs a better name. Sorry, whatever it is. I know it's important and I know it's exciting and it's very, very stressful, because if you get it wrong, your income is affected over the long term. So it's very important. Let me not undermine this idea of asset allocation. Until we come up with a better name, we'll keep calling it that.
Asset mix is maybe another one. To throw in a bit of a cooking terminology in the money show. So that combination of your cash, your bonds, your property, and your shares, and over time, I'm not going to get into all the academic studies, but let's just say that it accounts for the biggest reason why investors will be okay over their lifetimes or why they won't. And it's amazing to watch how, we look at the whole financial services industry, especially the investment industry. It spends a lot of time telling investors that, if we're a fund manager, we can choose the right share, we can choose the right bond, or, we can choose the right share at the right time. And so the one is about stock picking and the other is about market timing. And history shows that those two factors, they're nice to talk about. They're exciting. We can, come up with great predictions about how the world's going to unfold. But in the real world with real money, those two factors make up a tiny reason why your portfolio of money will go up or down over your lifetime. The biggest reason will be how much you're allocating to growth assets. So those would primarily, most of our lives will be around shares and property companies. And so those are the big growth assets in our lives. And if you decide how much to allocate to those correctly, you will be financially secure over your retired life. You get that decision wrong and you have big troubles. And often the decision, how people get that decision wrong, is they over allocate money to cash. They over allocate money to the assets that provide certainty, because unfortunately, cash, for the last 60 years, cash has given us a history of about 0.2% a year above inflation as a return in our country. And it's equally bad overseas. And you just consider any kind of income tax that you would pay on your interest, and you're probably going backwards with your cash in buying power, in the way that your money can actually continue to keep pace with your expenses. So 100%, Bruce. I mean, to get that decision right is really all you have to focus on. You actually don't have to worry too much about saying, should I buy, this bank versus that bank, or, this IT company versus that company. What you should be saying is, how much have I got in shares? Is it a nice spread of shares? Great. I've got the decision right. And to me, people always say, well, what's the right amount for someone who's living off their capital? And I think it's interesting how retirement fund regulations have actually landed on a number which I think is not bad. And that means somewhere around, let's say, 2/3 to 75% of your investments should be allocated to normal shares and property companies, both in South Africa and overseas. And I think that's the critical decision to get right.
Okay. Shares and property up to 75%. It seems like a huge amount, because people are just frightened of shares. And you can show people any number of graphs about share performances over the last 100 years. And yeah, there are blips and there are bumps. And there are hair-raising hairpin bends and turns, and lots of fear and trepidation. However, the long-term trends on most share markets in most parts of the world, most of the time, is from the bottom left corner, which is low, towards the top right corner.
Yep, and it's fascinating how I think I heard someone say today that he thinks South African investors are suffering from PTSD, post-traumatic stress, because we're so battered by local events, local politics, local economic events that are have been going badly for so long, that any kind of news that comes past our radar, we immediately assume it's going to be bad. And if it is possibly good news, we change the lenses of our glasses to ensure that we view it as bad news. And so just interesting to look at the average sort of balanced fund in South Africa. What's it done? I take your point that a lot of people would view 75% in growth assets as risky, but over long periods of time, a balanced fund will deliver a return probably around 8 to 10% a year over a 10, 20-year period. It's certainly what's happened over the last 10 years. And if you take the last 10 years, we haven't exactly had a glorious president with fantastic economic policy for most of the last 10 years. We certainly haven't had, corruption-free, high-growth, market-friendly, policies for most of the last 10 years. And still, an average balanced fund is delivering a return of 8% a year. And that's the important point to understand here. We can get really depressed about 1 or 2 years of bad performance. Similarly, we can get really excited about 1 or 2 years of great performance. But actually, we have to take our kind of nearsighted glasses off and put our farsighted glasses on and say, okay, what are we looking at over the long term? And over the long term, a good balanced fund, a good balanced mix of assets in a retirement fund will deliver the right amount of growth for investors. And if we look at what's going on now, even over a 5-year period, which has been really tough for South Africans, balanced funds delivered about 6% a year. I'm not saying it's great growth. In fact, it's fairly pathetic, but it's still 1.5% a year better than inflation. So it's important to know that mix of assets is really critical, and keeping a balanced mix of assets in the worst times and the good times is what gets you through the kind of the rocky times. And I think that's really the key message in a time that we're in now. You think of a lot of retired people, who are shell shocked by bad returns, and then add a pandemic to that, and it's just a really horrific time to try and be a rational, sensible, calm investor. I mean, I get that, but and so people are asking now, what do we do? And my view is, if you've got a living annuity, for example, make sure it's in a balanced portfolio. And then by all means, when the rand is at 14.51 or whatever it is at the moment, consider changing your living annuity mix to make it 50% in South Africa in a balanced fund, and then have it 50% offshore in a balanced fund. I think that's a great mix for most South African retired people or people that are just kind of financially free already. If you've got lots of money, sure, allocate a bit more overseas, and if you've got less, then maybe allocate a bit more to South Africa to get certainty of your income. But I think that asset mix is possibly the most important thing we can do with our investment money when we're living off it.
Well, just if the only point that anybody takes away from us this evening is just understand that you need to have long-term a bias towards shares, because it's the only way you're going to grow. And if you're growing your assets at an average of 8% a year, and you are using, let's say, 4% of your capital, if you're drawing down 4% of your capital every year, at least your assets are growing. Over time, you're not diminishing the pot, because you may live to a ripe old age, and that's a big risk.
Absolutely, and I think just my last little piece of good news on that is, telling people, I think we've probably been saying it on the show for the last 3 or 4 years. Now, just be patient; the tide will turn. And it's interesting to note that over the last year, the tide has started to turn. Now, we're seeing the JSE up over 50%. Yes, I know it was from a really low base in March last year, but still, it's the JSE is up. Yeah. Balanced funds are up just as an average over 16%. So we are starting to see that patient investors getting some rewards, and I have no reason to think that won't carry on for a year or 2 or 3.
There we go. Warren Ingram. A question for you coming up in a moment, Warren, and this comes from Lou. Lou has come into some cash. Lou has sold a flat and wants to grow the capital over the next 6 to 9 months, because Lou wants to put down a deposit on a new house. But Lou's got a problem, because Lou looks at deposit rates, and Lou thinks to Lou's self, I don't know if Lou is Louis or Louise, I don't know, but Lou. And Lou is going, I need to get as much growth out of this money as I possibly can in the next 6 to 9 months. So what Lou thought to themselves was they would make it your problem, that problem, in a moment.
The Money Show.
Personal Finance with Warren Ingram.
So, Warren, what is Lou's solution to the problem? We don't want to lose. We want Lou to win. Lou has got capital, wants to grow it over the next 6 to 9 months before putting a deposit down on a new property. How does Lou get the best possible return and make sure that Lou doesn't lose money?
Yeah, Marcel, I love the question, because it's such a tricky time frame, to invest money. When you look at money market unit trust at the moment, that they're probably delivering, interest rates of around 4 to 5% a year. And so, if you're investing for 6 months, that means you're going to receive a healthy sum of 3% growth on your money for that time. And as Lou correctly says, that's nothing. That's just that's going nowhere. And I think it's a kind of a really frustrating time frame, and especially if it's a big chunk of money. If you've sold a flat, I assume it's a big asset for you. I get the need to try and find a way for it to grow and work as hard as possible before you put it down on the next property. My concern is, I see Lou saying, how about an aggressive exchange traded fund or aggressive investment? So just to talk that through, an aggressive exchange traded fund means, something that can potentially give you, 50% growth in a year, or 50% over 3 or 4 years, which would be fabulous. Really lovely if it works out perfectly over the next 6 to 9 months. The problem is that an aggressive fund, the other side of the aggressive fund coin is that it comes with an equal amount of risk. So let's just say you put down your R1,000,000 that you got from your flat, you put it into a nice aggressive ETF, and what happens is the tech sector in America falls over. And all of a sudden, all aggressive funds, which will be mostly overexposed to the tech sector, suddenly lose half their money. And that's not a fiction, that's something that's happened consistently over the last decade or two, especially in the tech sector. And suddenly Lou has lost, and Lou decides, that Lou can't now put down the deposit on the new place. So I think Unfortunately, Lou, you're going to have to bank the money into something and buy the certainty that we've been talking about, so disparagingly before. And in this context, certainty is a really good thing, because if you've got an expense that's a known and your time frame is 6 to 9 months away, and that's the certainty, and you know you need to put down a fixed amount of money, then you cannot afford to take any investment risk, because you could see that investment just fall over. And so, unfortunately, Lou, the answer is, go and shop around for a good interest rate at a bank. Maybe if they, look at their fixed deposits, look at the money market rates, see where you can get the best interest. And unfortunately, you're going to have to make do with that. And then just don't forget that at the end of Feb, SARS is going to also ask you to pay some tax on that interest, unfortunately. But that's the best you can do. I don't think you should be taking any kind of investment risk with that money over a short time.
I couldn't agree with you more. And look, we don't know Lou's personal circumstances, but I'm wondering why Lou is sitting on the sidelines of a property market. And again, we don't know at what level Lou is wanting to buy, but we do know that properties in the region of up to price points of up to 3.5 million rand, prices are going up. If you put money into a fixed deposit, say you've got even R1 million, and you put it away at 6% in a super duper, I don't know, fixed deposit for 9 months. I don't know if you can get 6%. I suspect you might be able to if you fish around hard enough. Let's say you do that. That 6% may not make up the difference between the property that you like today versus the property that you're going to be asked to buy 9-12 months from now. Why not just get straight into the market and start and buy the property? I wonder. Is my question. I mean, is that an unreasonable question?
No, I think it's a fine point. I think at the moment, most people would be buying properties with bonds, and most of the time, those bonds will be at, maybe 90% of the value of the property. There are very few people that will be putting down, a very healthy deposit on a property. So, in Lou's situation, if that amount of money is significant, it means a couple of things. One, that Lou can negotiate a very healthy mortgage interest rate with a bank, so they can go. Lou can get a good low cost, low interest loan, and secondly, yes, it is becoming a buyer's market. A little bit of a buyer's market, but the point is, lots of these offers are subject to me getting a bond. And the point is, if you've got a nice big deposit, your certainty of the bond is much higher. So I think to jump in is a good thing. I think unless it's a property development that Lou really wants or something like that, I can't see the reason to stall.
Okay, good. Thank you, Warren. And then finally, what is RET? Oh, no. REIT. I was all excited that we're going to talk radical economic transformation, but you want to talk about REITs, which is a real estate investment trust, which is what most companies that own properties that are listed on the JSE are nowadays, or all of them, aren't they?
Close to all, not quite all. So the difference between a property company, that just a normal property company, and a REIT is that a REIT is required, in terms of the way it's listed, it's required to pay out a minimum of 75% of all of the income that it earns in a year to its investors. So if it's making 100 million rand a year in rental income, it must pay out a minimum of 75 million rand to those people who own the shares in that REIT. The balance of the income can be used then to kind of fund development of properties, or like keeping maintenance, or whatever the deal is. But that's a critical difference between a REIT and a normal property company, which can decide every 6 months how much income it wants to pay out to investors. And unfortunately, even REITs, in the whole lockdown scenario, had to actually stop. Quite a few of them just didn't pay any income at all. But yeah. So what is a REIT? A REIT is a way for investors to buy property businesses, but with the greater certainty that they'll get the bulk of the rental income paid to them for their income needs. And I think it is really designed for people looking for income that should track inflation and that should give you some capital growth over time. Sadly, REITs are not immune to big market and economic events, And what we've seen in the last couple of years is property companies in South Africa losing somewhere around 50% of their value, and a lot of them, paying nothing or half of the income that they normally pay. Let's hope that cycle's turning now. We're seeing more and more REITs starting to pay out an income again, but most of them are saying, sorry, we're only going to pay out about half this year. We need to see how COVID unfolds for the rest of this year and into the start of next year. But in general, quite a nice place to get a decent income that's more than what you can get in the bank.
Thank you, Warren Ingram at Galileo Capital.